Thanks again for joining us here on a Wednesday. I'm Marlon Bowling with you, your tour guide to the ag commodities. Boy, we've had a lot going on today. Even though it's the middle of the week here, we've had the markets kind of chopping on both sides of unchanged today. And we did have some overnight export sales to talk about. We had another sale of soft red wheat before we got the daytime session underway. And we had a sale of soybeans. In both cases, the sales went to China. Now, on the wheat side this morning, we sold over 300,000 tons to China, 372,000 to be exact. And on the soybeans, 136,000 tons. Everything went to China. It was all for the current marketing year as well. Now, we had some ethanol numbers that came out a little bit ago. And just to recap, the production really came up last week. In the U.S., we put out 1.076 million barrels of ethanol per day. And that was an increase of 65,000 barrels a day from the week before. The ethanol stocks, they pretty much held steady at 21.4 million barrels, maybe give or take a few there, and imports remained at zero. Now, with all that going on, let's get you updated on our current futures trade then. Our quotes are provided by bar chart here, and March corn is still down 5 cents at 485.5. We're a penny from the low of the day. In soybeans, even with the overnight export sale, they're really sagging. March down 9 1/4 now at 13.17 1/4. Didn't help that market one bit. If you look at wheat in Chicago, where that soft red wheat is sold, the March contract is now 639.5. Yeah, it's up 8 1/4 cents, but it's a dime off of its earlier high this morning. So it's a bit of concern there. And if you look at Kansas City, it's actually going back and forth, above and below unchanged. Right now, March is up a half cent at 663 1/4. In Minneapolis, you have that March wheat trading 3 3/4 lower. We're at 735 1/4. On March cotton, we started out, we were way over 80 cents this morning, and then they flipped around. Now we're at 79.52, and that's down 16 points on the day. We were talking earlier about the ethanol production. Well, in the energy markets, when you look at West Texas crude today, it's just taken a beating. We have January down $3 and a penny. We're at 69.31 per barrel. That's well under $70 a barrel. Big sell-off there. That's $3.30 off of its earlier high. Wow. I want to bring in Chris Swift, and we'll talk about this a little bit. He, of course, is with Swift Trading. He's in Nashville. So the wheat market is trading higher, but well off of its highs. It's kind of one of those deals where is the glass half full or half empty? How do you look at it?
Well, it's 7 days up right here, and it came off contract lows. A big short position had to get unwound, and I think really that's what it's more about, is that big short position being unwound, than it is a real surge in the demand. The demand aspect is great to see from it, and that demand is what probably took it off those lows. Now we have to have more and more demand to be able to keep it pushing higher. And unfortunately, looking at the corn, beans, and the crude oil market that you just mentioned, those are looking very recessionary. Even with the sales that we have seen in both corn and beans, that's still recessionary when we're going down on that kind of information.
What about this move that we're seeing in the crude oil trade? Of course, we had very strong ethanol production numbers. But when you have crude oil going down $3 a barrel and now we're under $70, is that going to weigh on the corn market or soybean oil?
I think both. Again, it's recession is what I think. And most of the listeners will know that I have been very friendly towards energy markets for weeks on end. But I finally just had to cave in and say I was wrong and moved my positions out of the way. But it just looks now with this breaking under $70 a barrel, still major conflicts in the Middle East and nothing really here in the United States to improve our energy policies. So I think that's what it's telling us, is this is recession in the future. We're just not going to have as much demand.
And with heating oil, the crude oil market going down as much as it is, heating oil or diesel fuel futures are also down today, almost 7.5 cents lower. We're at 256.7 per gallon on the futures trade right now on the January contract. We'll be back in a moment. We'll talk with Chris Swift about everything going on in our livestock markets after this. All right, we're back with you, and we're talking with the one and only Chris Swift of Swift Trading. He is based in Nashville. Let's get you updated on our livestock trade. Now, Chris has a specialty in the cattle complex. Let's take a look at what's going on. Man, I tell you what, we started out, it was just kind of flat. It wasn't doing much this morning. And then it's like somebody put it in neutral and shoved it off in the ditch. You have February live cattle down $1.90 at 167.07. And you have April down $1.42 right now at 170.07. You have triple-digit losses on the first 4 contract months now on the live cattle. And then when you switch over to feeders, now here, it's crazy the gyrations we're seeing here. You have the March contract posted an early high today of 219.72. Then it went all the way down to 216.20. That's about a $3.50 sell-off. And now we're at 217.30. So we're about right in the middle. We're only down 17 cents. If you look at that on the surface, you'd think, wow, that's a boring market today. But nay, that's not the case. So explain what's going on between the live cattle and feeders here on a Wednesday.
Sure, it's a very interesting situation because it is part of the agenda that is taking place in the cattle industry. First quarter of 24 is going to see elevated beef production from the placements we saw in September, October, and what I believe to be heavy in November. So that will carry us all the way out to the March, April timeframe. In the same first quarter where we see elevated beef production, I think we see a huge decline in placements of cattle because we have placed more cattle September, October, and potentially November. We tend to not place a lot of cattle in December, but January marketings of stockers and feeders in volume are only second to the month of June. So we tend to see a tremendous amount of cattle put on feed in the month of January, and that tends to be our summer beef product there. So right now, due to the elevated movement in the third and fourth quarter of this year, we should have elevated production of beef in the first quarter of 24, but we see lower placements in the first quarter of 24.
Okay, so that's a lot to absorb here. Let's go ahead and jump down to our lean hogs too, and I want to include that, see what's going on. On the lean hog futures right now, we're actually a little higher. They have flipped around to the upside. February up 25 at 69.60. But do you hold out much hope that they can build on that?
Not really. I think there is a strong seasonal tendency for them to trade lower, and unfortunately, they kind of reverted back into a bear market until you start trading back up above probably 75 or 76. It looks like a bear market, and the lean hog index down again today at 69.60, down 24. So you're dead in line with the February contract. December carrying a small discount to it. It goes off the board next week.
Okay, well, I'm glad you pointed that out. Thank you for doing that. Chris Swift with us. He's with Swift Trading, based in Nashville. Used to be right across the street almost, but
yeah.
Anyway.
It's always nice to have. And a regular guest to fill in.
Yeah, when I'm not here, he's here. And I lean on Chris quite a bit.
We all do. Thank you so much. Thank you, Marlon.